deep dive. Today, we're tearing apart the Q3 2025 earnings for Goldman Sachs. They came out last month.
Yeah, October 14th. And the numbers, well, they were pretty spectacular.
Right. Analysts called it market beating. So when a giant like Goldman reports a quarter like this, we kind of need to figure out what exactly happened, what drove it.
Exactly. Our mission for you, the listener, is really to get past those big headlines, find the strategic moves that actually delivered the success.
So the goal is to walk away knowing, okay, what was the real engine here? And crucially, is it sustainable?
Precisely.
Okay, so let's kick off with the top line story. The numbers that, well, sent the stock flying immediately. What did Q3 look like, big picture?
It looked powerful. Q3 net revenues hit $15.18 billion.
$50.18 billion, wow.
Yeah, and that's up a massive 20% compared to Q3 last year. Now think about the current climate, right? Deal-making's been hesitant, interest rates are volatile.
So 20% growth in that environment is quite a statement.
It absolutely is. It suggests something fundamental shifted.
Right, either in the market or, how they executed their strategy.
Yeah.
And I assume that revenue flowed down to the bottom line.
Oh, definitely. It fueled a corresponding explosion there. Diluted earnings per share EPS rocketed up to $12.25.
$12.25. What was it last year?
It was $8.40. So that's a jump of, get this, 46% year over year?
46%. That's jaw-dropping.
It is. And the other key metric, annualized return on equity, ROE, came in at a very healthy 14.2% for the quarter. That's really top-tier performance.
Okay, so massive revenue growth, huge profitability. But the CEO, David Solomon, the sources say, he's still talking about long-term efficiency, focusing on the client franchise and risk management.
Yeah, and that's what's interesting, right? They're celebrating this huge success, but he's already signaling, look, the pressure point is efficiency. He mentioned operating more efficiently, helped by new AI technologies.
So even while the profits are rolling in, they're saying we need to get leaner, use tech.
Exactly. They know success brings scrutiny on costs, so they're making it clear. Modernization, expense control, that's the long game here.
Okay, let's break down where those profits actually came from, starting with the core engine, Global Banking and Markets, or GBM.
Right, GBM. This was, overwhelmingly the dominant piece, $10.12 billion in net revenues.
$10 billion out of 15 total. Wow. And that was up too.
Yep, up 18% year over year. And the real alpha, the standout performance within GBM, came from investment banking fees.
Okay, how much were those?
$2.66 billion, which is soaring 42% higher than Q3 2024.
42%. Okay, we know M&A was pretty quiet for a couple of years, high rates, nervous markets.
Yeah.
What happened this quarter? Did the dam just break?
It looks like it. The data suggests companies just, finally pulled the trigger. They agreed on valuation, financing terms, leading to a surge in completed deals.
Completed deals, that's the key.
Exactly. Advisory fees, which is mostly M&A work, they were the absolute breakout star, up 60% year over year.
60%, just from M&A closing.
Yeah, it reflects a really significant increase in the volume and probably complexity of deals that actually crossed the finish line in Q3.
Okay, so deals are closing. What about raising capital? IPOs, debt. Is confidence returning there too?
It seems like it. That was strong too. Debt underwriting jumped 30% year over year, driven heavily by leveraged finance activity.
Leveraged finance. So big buyouts, maybe restructurings.
That kind of complex debt-heavy stuff, exactly. And equity underwriting, that was up 21% year over year, mostly driven by IPO's initial public offerings.
Okay, so the whole investment banking machine seems to be firing again. But is this just a temporary spike? What about the pipeline, the backlog?
That's a great question, and the sources are pretty clear here. The investment banking fees backlog was, quote, essentially unchanged from Q2.
Unchanged, so it didn't drop even after that huge quarter.
Right, which is a very good sign. It suggests the pipeline is still full. That 42% surge wasn't just clearing out old deals. Looks like the momentum is stable heading into Q4.
Okay, that's encouraging. So fantastic performance in IB. But GBM also includes the trading side, right? FICC and equities.
Correct. Fixed income, currency, and commodities, FICC, and equities. That's the part that often provides stability when M&A cools off.
So how do they do? FICC first.
FICC was strong. Net revenues of $3.47 billion, up 17% year over year.
17%. What drove that?
It was pretty broad-based. Strength in FICC intermediation, that's your classic trading in rates, mortgages, commodities, and FICC financing, things like mortgage lending, structured lending, that also did well.
Okay, solid on the FICC side. Now, equities, I heard that was a bit more mixed overall, but different stories inside.
Yeah, that's a good way to put it. Equities was up 7% overall, net revenues of $3.74 billion. But if you peel it back, like you said, there was a clear winner and a clear, well, laggard.
Right.
The winner was equities financing. That's basically prime brokerage lending money and services to hedge funds.
The stable fee-based side.
Exactly. Less volatile, tied to client assets, that hit a record, up 33% year over year.
33% in prime financing.
Wow. Huge. And that strength was really needed because it helped offset, quote, significantly lower net revenues in equities intermediation.
So the actual trading desks, cash products.
Right. The pure trading side saw a slowdown. So you see the strategy working, lean into the reliable financing revenues while the trading environment was tougher. It's a good balance.
That makes sense. A powerful strategic balance, yeah.
Yeah.
Okay, let's shift gears. The other big growth engine the CEO talks about, asset and wealth management, AWM.
Right. Managing client money, less capital intensive, more stable fees. That's the long-term plan.
And how did AWM do?
Pretty well. $4.4 billion in net revenues, up 17% year over year.
17%. Solid growth. What's the key metric there? Assets.
Assets under supervision, AUS. That's the gold standard. And it hit a new record, $3.45 trillion.
$3.45 trillion. Okay. How much did it grow just in the quarter?
It grew by $159 billion quarter over quarter.
Whoa, $159 billion in 3 months.
Yeah.
That's massive. Okay, here's the AHA moment for you listening.
Yeah.
How much of that was just the market going up versus new money coming in?
Yeah, that split is crucial. And it was almost perfectly 50-50 this time.
Really?
Yeah. Net market appreciation, stocks and bonds going up accounted for about $80 billion of the increase.
Okay, so the markets helped, but that means the other half.
The other $79 billion, that was pure net inflows. New money from clients.
$79 billion in net new money in one quarter. Where did it come from?
It was broad-based, which is another good sign. About $29 billion from institutional clients, $28 billion through third-party distributors, and $22 billion directly from wealth management clients.
So they're successfully gathering assets everywhere. And that drives fees, obviously.
Exactly. The growth in management and other fees directly reflects managing that bigger pot of money, that higher average AUS.
Okay. The report also mentioned private banking and lending revenues jumped significantly, up 40% year over year. Was that also just asset growth?
It was linked, but there's a specific reason for that big 40% spike. We need a little footnote here.
Okay.
It was primarily driven by getting interest paid on a loan that had previously been marked down, impaired.
So a one-time recovery, essentially.
Pretty much. It's great. It shows good risk management, good collections, but it's not something you'd expect to repeat every quarter at that level.
Got it. Not recurring thing.
Right.
What else in AWM? Are they still cleaning up the balance sheet there?
They are. You see it in debt investments where they actually had net markups this quarter versus markdowns a year ago. And they're continuing that shift away from holding capital-intensive stuff on their own books. Historical principal investments dropped another $1.1 billion, down to just $6.9 billion now.
So strategic subtraction, as you called it. Shedding the old model.
Exactly. Moving away from being a bank holding lots of its own risky bets towards being more of a services and asset management firm.
Okay, that strategic shift seems clear. Now let's talk about platform solutions. This is where the remnants of their consumer banking push live, right?
That's right. Things like the credit card partnerships.
Okay, this segment's net revenues apparently soared 71% year over year to $670 million. That sounds amazing. But I feel like there's a catch.
There is a big catch. This is where context is absolutely critical. That 71% jump, it's mostly an illusion.
An illusion? How?
It's because the comparison period, Q3 2024, was terrible for this segment. It included significant net losses and markdowns because they were actively divesting consumer stuff.
Like the GM card deal in Green Sky.
Exactly. The GM credit card program, the seller financing loan portfolio, those were moved to held for sale a year ago, and that created huge losses in the baseline quarter.
So this quarter's $670 million isn't necessarily massive new platform growth. It's more that they didn't have those huge losses dragging them down like last year.
That's the core takeaway. It signals the bleeding has stopped or at least slowed significantly. The costly exit from those non-core consumer businesses is stabilizing. It's the absence of prior pain more than new gain, if that makes sense.
Yeah, it does. Less negative is positive, basically. But speaking of consumer risk, they still have that credit card portfolio.
Hmm.
Did they have to set aside much for potential losses there?
They did. The provision for credit losses was $339 million for the quarter.
$339 million. And where was that concentrated?
The report says it primarily reflected net provisions for the credit card portfolio. So yes, anticipating or realizing charge-offs there.
And this really highlights the difference in risk profile, doesn't it?
Yeah.
Between their traditional corporate clients and the consumer side.
Absolutely. The numbers make it incredibly stark. Look at the annualized net charge-off rates they reported for their core wholesale loans. Tiny, just 0.1%.
0.1%.
Okay.
And for the consumer loans?
Brace yourself, 5.6%.
5.6%. Wow.
Yeah. That 5.6% is the ongoing cost of running off that consumer portfolio. It just hammers home why strategically exiting that business makes sense for them. It's where the credit risk still lives.
Okay, that's clear. Now let's circle back to efficiency. We started by saying the CEO's focused on it, talking AI. Yet operating expenses were up 14% year over year, $9.45 billion.
Yeah.
How does that square?
Right. You can't talk efficiency while costs jump 14%. It seems contradictory, but you have to connect the dots. A big chunk of that increase is actually a direct result of the firm's success this quarter.
How so?
Well, higher compensation and benefits, for one. Profits were way up, deal activity was strong, so bonuses and comp go up. That's expected. They also had higher transaction-based expenses, just from doing more deals.
Okay, so some of it is the cost of success. But surely not all 14%.
No, not all. There were other factors. Charitable contributions were up. And significantly, there was a big jump in net provisions for litigation and regulatory proceedings.
Legal costs. How much did those increase?
They went from $41 million in Q3 last year to $131 million this quarter. So that's a noticeable jump, too.
Okay, so you combine higher pay due to success, more deal costs, and then these higher legal provisions, and that gets you to the 14% increase.
Exactly. So the question for you, the listener, becomes, is this 14% hike just the new sustainable cost of running a highly successful, complex firm? Or does that AI and efficiency push have to kick in now to actually bend that cost curve down and protect these high margins?
Yeah, that's the tension right there. But despite the absolute expense increase, the overall efficiency ratio actually improved, didn't it?
It did, yeah. Because the revenue growth was even bigger than the expense growth. The ratio measures cost relative to revenue. Year to date, it improved to 62.1%, down from 64.3% for the same period in 2024.
So for every dollar they earned, they spent slightly less to earn it this year. That's operational leverage.
That's the definition of it, yeah. So better efficiency in that sense, even if total spending went up.
Okay, let's quickly wrap up with the balance sheet and shareholder returns. How's the overall health?
Looks solid. Total assets grew slightly to $1.808 trillion. Deposits are up to $490 billion. Liquidity looks very strong.
Yeah.
Global core liquid assets averaged $481 billion for the quarter. Plenty of cushion.
And capital ratios, CET1.
They saw a slight dip quarter over quarter. Standardized CET1 came in at 14.4%. Advanced CET1 at 15.2%.
Why the dip? Any concern there?
Not really a concern, more a reflection of increased activity. The report says it reflects an increase in credit risk-weighted assets, or RWAs.
Meaning they're doing more business that carries some risk, so they need to hold capital against it?
Essentially, yeah. Increased lending, more trading activity that bumps up your RWAs. So holding the ratio steady would require even more capital. A slight dip just signals more business being done, not necessarily weakness. Still very strong ratios.
Got it. And the payoff for shareholders, capital return?
Very strong. The firm returned $3.25 billion to common shareholders this quarter.
$3.25 billion. How is that split?
$2 billion was used for common share repurchases. They bought back 2.8 million shares. And the other $1.25 billion went out as common stock dividends.
$2 billion in buybacks is pretty substantial. Helps boost that EPS number too by reducing the share count.
Exactly. And the book value per common share, sort of the intrinsic value marker, kept climbing. It hit $353.79, up 5.1% so far this year.
Good result. Okay, so let's try to synthesize this. What's the big picture takeaway from Q3?
Well, it seems the core investment banking and markets businesses are absolutely firing on all cylinders again, especially with that M&A surge. At the same time, the big strategic pivot is clearly working. AWM is pulling in serious new money, and they're successfully, methodically cleaning up and getting out of those non-core consumer bits.
And the strong results flowed through to employees via higher comp and to shareholders via dividends and buybacks.
Right. It was a powerhouse quarter, validating both the core franchise and the strategic shifts.
No doubt. But, as we discussed, that CEO focus on operational efficiency looms large, especially with expenses rising.
And that really tees up the final provocative thought for you, the listener. We saw operating expenses jump 14% year over year, driven by success, but also by things like litigation costs. So the big question is, will that strategic push for efficiency, especially using new AI technologies, actually deliver enough measurable productivity gains over the next few quarters? Enough to offset future expense growth, keep costs in check, and maintain this really impressive level of profitability?
Or will rising costs start eating into those margins even if revenue stays strong? That intersection of soaring revenue and rising costs,
Yeah.
that's definitely the space to watch.
Absolutely. That's where the next battle for performance will likely be fought.
A really challenging question for the coming quarters. Thanks for diving deep with us today.